Hello and welcome to the Monday Futures Market Outlook for November 8th, 2010. This is Patrick Sresna. For those of you that have not had an opportunity to try out eminisource.com, 30-day complimentary memberships are available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that we've gone through. We bullishly got above that 80-week moving average back in 2009, and really at this juncture, we continue to stay bullishly above there. At this stage, we had a pullback during the summer here where the support lines have held at the key levels, and subsequently the market's reversing and continuing to push higher. We've now made a new year high on the market, and we're overdue at some stage for some form of a profit-taking cycle. But in the bigger picture, we simply believe that this bigger picture trend is in place, and even though there's any maybe short-term blips, we're not convinced that there will be any major reversal here at this stage within the market. When we take a closer look at that S&P 500 on the daily charts using the E-mini futures contracts, we had a very bullish breakout here above the 1205, 1215 focal point, which is where the highs of the year actually laid. This was obviously driven by a Republican victory and subsequently a very generous quantitative easing coming from the Fed. But really at this stage, we're now at a critical stage. The dollar index is strengthening a little bit overnight, over the weekend, and we're now going to see whether or not the bulls can actually hold this breakout. What we're going to be watching for is not only this 1205 to 1215 area, but theoretically we could even have a pullback even as deep as the 1190 level. But so long as all the selling is contained within these areas and then subsequently rolls up, we should see the 1240 to 1250 area on the upside on this momentum push. Now, one thing we were looking for, not only at the 1200 level, but as high as the 1220 area, was at some stage for there to be about a 5% market correction getting underway. Now, this could theoretically be where something like that would occur, but what will all be about is when we get a little bout of selling here, which could come in as early as today or tomorrow. When we see that selling coming in here, will the bulls be able to contain it and hold the key support lines? If they do, then we could theoretically still see another push higher now that we've broken to a higher high before we get that correction. But at some stage, that profit-taking cycle will begin. Just to review our key points, we are now intermediate bullish with only short-term risk of profit-taking or risk of pullback here. The market has broken to a new year high, which is certainly a good accomplishment, but it is done so without there being any real solid pullback at any stage, and therefore it's very stretched thin on this rally higher. Short-term investors should be cautious about chasing this market. Even if you think about it, even if the S&P was to boot a straight line to the 1240, 1250 area, which is our next upside target, you only really have at this stage maybe 15 to 20 S&P points potential on the upside, but at this stage are susceptible to the risk of a full profit-taking cycle. So the risk-reward of chasing this market is marginal. We're also watching the U.S. dollar index. We'll have a chart on it in just a brief moment. But if the dollar index strengthens, it will pressure the markets to profit-take here. And so as goes this dollar, it will probably go the market. It will also be very interesting to see when the market finally drops this inverse dollar correlation. It has become a very predominant inverse trade, but that relationship is not one that traditionally stays true. And there's many periods where the market moves to the beat of its own drum without the dollar being such a strong influence on it. And so if the dollar index starts this rally, it'll be very interesting to see if the market can really break away from that inverse correlation. Long-term investors could buy, but will need to stomach profit-taking cycle. Next year, I want to take a look at that NASDAQ 100. One of the other reasons why we're concerned about profit-taking is that NASDAQ has just finished a completed measured move on the upside. So our upside targets have all been fulfilled, which gives, at this stage, the risk that there's going to be some sort of a flag or wedge. This, again, does not mean that we believe a market top will occur here, but simply that the NASDAQ has a tendency to proceed 2 steps forward, 1 step back. back, and therefore off this level for us to see 100 NASDAQ point pullback would be very natural. Next year, I want to take a look at that U.S. dollar index futures, and this is exactly what we were talking about here. We have this price action that's extremely choppy. The dollar index last week was actually attempting to break down and actually make even lower lows. And then there was a window open for this dollar index to head right down to the 74 level, where the lows came in at the start of the year. At this stage, though, we're now seeing two reversal candles that are creating this chop along this bottom end support line. In fact, that we can almost drop that focal point down toward the 76 level, at 76, 76.50 rather, up at the 77. If this U.S. dollar manages to rally to 78 or even 78.50, roughly around where those previous highs are, where the blue line is, that would indicate that we may in fact be seeing some sort of a short-term bottoming formation for what will end up being a bigger retracement in the dollar index, maybe up toward the 80 level on the upside. If that was to be in the cards, that will put a lot of pressure on this market to profit take, as well as to see some profit taking in a number of different commodities. So watching what this dollar does will give us a pretty big cue as to how we should be trading over the next week or two. Next year, I want to take a look at the gold futures. We're having a key retest along the highs. We already exceeded the previous high, but are reaching another round number target, which is that 14.10 area, and seeing some stalling. Again, it will be difficult for gold and silver to continue to rally if this dollar index reversal is legitimate. This could, in fact, be a key top retest equivalent of something like a double top. If the dollar index reverses, then gold could very easily find itself back in the 1320 to 1330 area. Now, gold has in the past moved out of correlation with the dollar, so if there's enough momentum, we certainly can't rule anything out. So now that it's broken to higher highs, but I would remain skeptical about the sustainability if the dollar is showing any legitimate strength. Next year, I want to take a look at the E-mini crude oil futures contract. This is crude has now reached its year highs around that 86, 87 level. There's a measured move that even targets a 90, 91 focal point up above. So there is room for crude oil to still go higher. But again, crude oil has been trading very much in unison with the dollar. And if the U.S. dollar index again makes that rally, then we could be looking at a reversal off this key overhead resistance level and a consolidation back down toward the 83, 84 level. The only way we would target 90, 91 is if that dollar index got back down below that 76 level on the downside and really started to show some aggressiveness, especially if that euro reversed back up toward 141, 142. If we saw all those things happening, then we would see these markets accelerate from there. Finally, I want to take a look at the 10-year Treasury note, and here we had the Fed intervention primarily being demonstrated here in this chart. As the quantitative easing announcements came out, we saw some very significant buying pressure on the upside of that 10-year Treasury note, pushing yields again to lows of the year. We really at this stage could see a potential upside finish target off this wedge, finish off in this 128, 130 level, where this again there's room for this to get up into these targets, but we're not particularly excited about chasing the 10-year Treasury notes. There's a lot of people that are using this Fed buying as a mechanism for actually distributing the bonds, and so this would be a very natural place for us to find some significant overhead resistance on that 10-year Treasury note. I don't necessarily want to short it here because fighting the Fed is not exactly something that makes a lot of sense, but in the same regards, being skeptical about the sustainability of this breakout is also in question. So I would be very kind of wishy-washy about this 10-year Treasury note until we see some further technical evidence as to what it wants to do. That was your Monday Futures Market Outlook. Thank you for joining me.